G'day and welcome to this week's video. This week we're going to have a look at what's wrong with managed funds. I'll also cover off on what's right with them as well, so I don't want to be too negative. Now if you get some value out of our videos, please subscribe to the channel and please share the video on to family or friends. And down in the description below there's a whole heap of information there, and there's some free financial courses, really just information, education to help hopefully make you make better financial decisions. So what's wrong with managed funds? Well, look, in our industry is driven by financial products. We've just had a Royal Commission where the linkage between financial product providers and their particular advisors has come under scrutiny. But I want to take you through some of my experiences that I've seen over my 21 years in the industry to consider what are some of the issues with managed funds. And essentially the unit trust structure, it's far from perfect, but it's fantastic for banks and fund managers and the institutions that have these products, because they're essentially open-ended, so you can continue to add more units and clients and funds to one entity. So they're essentially built for scale. So if you've got a team of 10 people running an Australian share fund and they're managing $100 million, to manage $400 million essentially still takes the same infrastructure. There'd be a small increase in cost, but not substantial. So for the fund managers themselves, they're a fantastic model and work beautifully because they're so scalable. But for new investors that come into an existing fund, and let's say that we're outside of superannuation and we do need to consider tax, a lot of the unrealised capital gains that sit within these structures is there to be realised at some point in the future. So a new investor that comes in, say at the start of June, will often get quite a large tax bill, or a lot of income that is distributed out of the fund at June 30, as it needs to each year, and that's going to be taxable at that new client's marginal tax rates after any discounts that may be applied. But they've been there for a heartbeat for say less than 1 month, and all of a sudden are dealing with a capital gains tax issue which bumps up their income and therefore their tax payable. So I've seen that affect obviously the tax they've paid, but also Centrelink outcomes, and these clients have only been there for sometimes less than a year and sometimes less than a month. The high turnover of assets, as the fund managers have different concepts and ideas, they're buying and selling to navigate the markets or their strategy, and obviously that has tax consequences. So the fund manager is not looking through and considering each individual investor's tax outcomes, and again this has consequences and tax payable. As always, fees. There is a fee for these guys to manage the money. My clients pay me a fee to manage their money. So, and fees have an impact on your net return. And one thing that I've always said with fees and returns, that returns are variable. I can never guarantee a return for my clients, but fees are a guarantee. So if we can reduce fees each year by a certain amount, well, that is a given, where I can never make any promises when it comes to returns. And one issue that is not widely known, probably up to the GFC, but it was an accountant, a local accountant told me and said, "Hey Rob, you do realise that if something goes wrong, these funds can be frozen." There's a clause in the structure in the trust that essentially means that the funds can be frozen and you can't withdraw your money. And that's exactly what happened during the GFC, when we had the government guarantee on term deposits and bank accounts up to $250,000 implemented. All the fixed interest trusts and funds, the income funds, people were trying to get all their money out of that, and they were frozen. And still to this day, there are still the remnants of a few funds that are still frozen. So not ideal from that point of view, and obviously there was extreme circumstances that have caused that to happen. But again, it's one of the risks, and why the trust structure is not perfect, and the reason why they give the ability to do that, and that's to stop a run on their money. And if people want their money at once, it means that they're essentially going to be a forced seller, and you never get good prices when you're a forced seller. So what's the alternative? What have we done over the last 15 years? For the most part, wherever possible, we'll go directly for our clients' entity, their super fund, their trust account company, or their individual or joint names. So if we like a particular business that we regard highly, and that might be Google, which is Alphabet, it might be Microsoft, it might be Magellan Financial Group, which is a funds management business. We'll go and own the asset directly. You have your own, when you buy in, you have your own set cost base, and you get to manage your capital gains or losses through our systems on an ongoing basis. So we're very tax aware. You can use separately managed accounts, and there's also many listed investment companies like African Argo, which have been about for decades. And there's also exchange traded funds, and also there's actively exchange traded funds. At the start, exchange traded funds, ETFs, were predominantly index based through BlackRock, iShares, or Vanguard, but now you can have actively managed exchange traded funds to get access to international shares where it is harder to transact overseas, to go and buy Microsoft or Google directly. So the upside to manage funds, well, with very little amount of money, $1,000, $2,000, you can invest into a managed fund that gives you a huge array of access to many different companies and asset classes, and it gives you fantastic diversification. So they do form an important part of any financial advisor or investor's toolkit, but there are just some areas that we will choose to go direct in preference to going via a product or a managed fund. And that might be where we're talking about a lot of money, or a self-managed super fund will prefer to go direct wherever possible, or if the money is invested in someone's individual name and it's outside of superannuation, and that means that we've got some flexibility in terms of costs. Where there is no tax return for that particular entity, it's still just the client's normal tax return. So there are some upsides to managed funds and these products, but there are scenarios where going direct, it can be more fun, and also reduce fees, and give you more of an insight to what you own. Thank you for listening, and we'll catch you next week. Give us a thumbs up. Please subscribe to the channel, that'd be great, and check out the resources below. We'll speak to you soon.